and welcome to Duncan Toplis On Air. I'm Caroline Cleary, the Chief Marketing Officer at Duncan Toplis, and today I'm joined by Graeme Hills, who is our Head of Tax, and by Heather Hodson, Chartered Financial Planner at Castlegate Financial Management. And today we're going to be talking a little bit about the 2025 Spring Statement that was recently delivered by our Chancellor, Reeves. Welcome to both of you.
Thank you very much.
So we'll start with you, Graeme. What was your overall response to the Spring Statement?
I think it was largely as expected. Really, there's no great surprises in there, which was always a good thing. Obviously, the Labour government committed to one fiscal event a year, and that was very much meant to be the autumn statement that came in at the back end of last year. So certainly from a tax perspective, there are no great changes expected, and that didn't happen either. So that's very much what we were hoping for and what we delivered in that respect.
And Heather, just turning to you, is how does the Spring Statement compare to previous budget announcements?
I think it wasn't a budget, and I think that was good news for most people. So there wasn't any big tax changes. It was very much looking at what the spending plans were. So I think it's kind of a bit of a stopgap, and then let's wait and see what happens in the autumn.
And I suppose with not much being announced, what announcements do we take from the autumn budget in terms of pensions and inheritance tax, and what are you seeing in the marketplace?
Yeah, so that has been the biggest point of discussion, definitely, since the autumn budget. Primarily, we haven't seen any changes in terms of state pension legislation. Triple lock is still in place. State pension has increased by 4.1% from 2025, which equates to the full state pension will be £230 per week. In terms of wider pension planning, that's where the biggest changes have been, and that's where all of the questions are coming from all of our clients in this area. So from 2027, the proposals are that pensions are now going to form part of the estates for inheritance tax purposes, which is a major shift from what we've had since 2015, where the Conservative government brought in a very friendly set of pension rules that have been in place for nearly 10 years. So from 2027, pensions are going to be included in estates. That does mean that clients are going to have to think about their overall inheritance tax exposure and what that is going to mean. Primarily, we're seeing conversations being tilted to how we're going to use those pensions differently. Like I say, for the last 10 years, we've probably been telling clients, don't use your pensions, leave them till last, because they are currently outside of the estate for inheritance tax. But 2027, which is only 2 years away, that's going to change. So it will shift how people use their pensions going forward.
Are you having lots of conversations about tax-free cash drawdowns?
Yes, very much so. So clients, and I think they're nervous about whether tax-free cash lump sum. So currently you can take 25% of your pension fund without paying any tax. And that is still in place. There's been no changes from being announced on that front. But the conversation is now leading, well, if my pot is inside of my estate on death, should I be drawing that 25% out now? And that is a conversation that we're having. There's not a solution and an answer that will fit every client's circumstances. So it's very much that advice on a case-by-case basis.
And I can see you shaking your head, Graeme, so seeing similar in the market?
Yeah, absolutely. And that's a very emotive thing. Obviously, very much the same conversation. We talk about inheritance tax planning, touch your pension pot last because it's all outside of your estate, and all of a sudden it's brought back in again. It completely changes your whole plan. And obviously, your pension pot is a big part of your overall life plan. It's how you're going to fund your retirement in your later years. So people have suddenly got to change that plan and how that works. It's a big shift. That's what these changes have really made. It's not just tax and numbers. It's people's life that this is actually affecting. The tax-free cash lump sum drawdown, the thing I'm struggling with a bit, yes, I get that it's going to come into the charge for inheritance tax, but it's still 2 years away. A lot can happen in those 2 years, and it is fully protected in those 2 years. So, yes, make the plans and have a good think about it, but don't necessarily jump to that action straight away.
Yeah, no, I totally agree. It's not, we're not telling clients, we're trying to make sure that the plan is still in place for what they were trying to achieve. It's not a knee-jerk reaction of these rules have been announced, let's just grab what cash we can. That's not what we're planning for and advising. So
I suppose in terms of our listeners today, if I'm sat at home and I'm taking on board what you're saying, what actions do I need to take?
Make sure you've got an advisor, go and seek that financial advice, build the plan, the financial plan that to meet your objectives, and get the appropriate advice, both from financial advice and also tax planning advice as well, just to make sure that you're in the position that the best position that you can be in, subject to the rules that are being brought in.
Yeah, really important time for individuals to be thinking about what those next 2 years and future can look like too.
Yeah. And it goes a lot further than that as well, because obviously we had other changes to agricultural property relief and business property relief that have very different applications as well. That comes in from next year. That's from April 26, so that comes in. And again, the plans that you once had before, which were great and would hopefully see you through till the end of your days, as of last October, they don't work anymore. So that's where you have to completely rethink what your wills look like, what your trusts you might be using are, whether you're in a limited company format or not, for example. All those different things that you thought you had all sorted and were working very well for you, you need to rethink them. It might be that they are still absolutely fine. They might still work for you, but you're doing it on a different set of rules than you were before. So there's a lot of very different changes to how you structure that going forward.
So a real message there of check, as you said, speak to your advisor and make sure that you're ready and you're in the best position for what's potentially coming next.
Definitely.
So turning to the budget statement again, but also the update in the spring statement from Rachel Reeves. Graeme, what's the most significant takeaway that you could take from a statement where we've said already there wasn't
from nothing?
Amount.
Sure.
Yes.
Okay, I can expand on nothing. No problem. Well, I think part of it is the fact that there's very little tax changes. Obviously, we have talked about the fact that they have committed to one fiscal event a year and they have stuck to that. So that was a positive thing. There was a lot of doom and gloom in the lead up to it and thought that they might make some changes anyway, even though it's not meant to be that fiscal event. So they have stuck to that. So that's a positive thing. Similarly, that when they made promises as part of their election pledge, they said no changes to income tax, to employees, national insurance and VAT. So that they've stuck to those promises from the election pledge as well thus far. So that's a very positive thing that what they said they were going to deliver, they actually have done. But I think also to take from that is the sort of highlighting of what might come in the future. I think Heather alluded to it earlier that although it was no changes at this stage, it wasn't a very positive budget either. The growth forecasts were down. It wasn't a general good news story on the whole. One of the things they did change was ramping up their tax avoidance division in HMRC to make sure they can go after the tax that's already there. Obviously, that isn't an increase in tax, it isn't a big fiscal event, but it's putting funds in to go and collecting more revenue. So that's something they're going to be focusing on quite a lot in the future. And there are still gaps in the budget and in the overall financial summary for the country. So do we think it's done? There were big changes, the big costs incurred as part of the October budget last year, which we're going to start to see very soon. But is that going to be it? Or are we going to have another hit in the autumn budget this year? And that's the thing that I don't remember a spring statement where the press have generally talked quite so much about what could come in 6 months' time. Quite so much. Normally it's been a case of where are we now and what does this mean? But it's very much a case of but what next? Yeah. And that's always a bit unnerving.
And then I think you talked there about the limited growth that we're seeing, and one of the things that was in the statement, which we saw Alison Smith commentate on in the media, was around the construction sector. As a business with a significant number of construction clients, are there thoughts that you might have for people in that industry and what they need to be considering?
Yeah, I think part of that is obviously the big increase to the national minimum wage, which will affect a lot of their workers, and tying in with the national insurance increase as well. So from a tax perspective, that's a big increase in overall costs, both in level and in the taxation on it. So the employer's national insurance did increase or will increase from 3 days' time as we record this. So that's going to be a big increase for that sector, where they really need to be thinking go ahead of what that's going to cost and how they can plan for that. Again, it's all very good having these plans in place. They suddenly changed again from last August, and that's a big increase to your bottom line with no increase to the top line. You need to work out what impact that's going to have on your business, how you can structure your workforce and deliver that service to the clients.
Yeah, so big opportunities to get ahead of that change and be ready.
You absolutely need to. Yeah.
And then I suppose turning back to people's personal finances, Heather, and particularly around the savings, pensions and income tax, what positives did you find, or are you finding?
Yeah, well, the positives were that there was no changes, and that's a key. So allowances are still available to be utilised, very much ISA allowances. So the ISA regime hasn't been changed, and we are able to utilise up to £20,000 each year in tax-free savings. So that is definitely something to take advantage of and try and make sure that before the end of the tax year that you're utilising that allowance, either in a cash ISA or into an investment ISA if you can afford to take a longer term position. Same with pensions as well. Whilst we have got the changes in the death benefit side of things and inheritance tax changes in 2027, they are still very much a tax efficient investment. So if you have got excess savings, if you've got excess income that you can funnel into a pension scheme, you are still going to qualify for tax relief for higher rate tax relief, basic rate tax relief, or additional rate tax relief. So you're going to benefit from those tax reliefs. And also, if you've got excess money in a company and as a corporate structure, you can funnel money into pensions and generate corporation tax relief. So they are very tax efficient still. And if we have got that surplus funds available, then that is still a vehicle that you would look to go to. For those opportunities.
I think, sorry, go on, Graeme. You go.
No, I was just going to ask a follow-up question on your ISA point. Obviously, they didn't change it. They talked about restricted to cash ISAs, so the rest will be stocks and shares ISAs to try and boost the share economy. There's still some rumours that might happen a bit further down the line. If you're a client who had that mindset, that will change. Is there anything you do differently now, or?
Well, I would always maximise it. So use your allowance and don't lose it, because it's there now. We know we can get 20,000 into ISAs, and it will protect you from paying income tax and capital gains tax. And I think the question for longer term planning will be to get that advice if the rules do change. For some people, cash ISAs are going to be suitable, and they will fit a need for some clients. However, if you've got a longer term view, or you can afford to take any additional risk, then investment ISAs are a great alternative. And again, that's something to go and get financial advice and talk through with a professional.
And generally speaking, if you can afford to do so, it's best to use that allowance earlier in the tax year rather than waiting until the end?
Oh, 100%. The earlier that you get that contribution in, the greater the tax benefits are. You get a whole tax year rather than just the last few days of tax-free benefits. So yes, we would urge people, use it if you haven't done in the next few days, but then try and get in your allowance on 6th of April if funds allow you to.
So possibly a time for the swift action. And then we've also talked a little bit around resilience being non-negotiable, and resilience is something businesses and individuals certainly need in a time of change. And we have had some announcements, and over a significant period, announcements about the changes that are coming in making tax digital, Graeme. So what is it that's actually been announced?
So the change itself is a relatively minor one that was announced as part of the spring statement. So making tax digital comes in next year. So that's going to be very much a online record keeping and quarterly submissions to HMRC of your income is broadly what it's looking to cover. The threshold over which you've got to submit to making tax digital is 50,000 of income from next year. It goes down to 30,000 the year after. And the announcement in the spring statement was there's going to be a 20,000 threshold from 2028. Why it's particularly significant is that making tax digital for self-assessment has been talked about for about a decade now, and it keeps getting pushed back to the extent of when we talk about it in the industry, it's sort of been it's never going to happen sort of thing. So when you're trying to plan around some of these things, you can't really plan for something that keeps getting bumped back and back. This is very much a statement of it is happening, it's coming in next year, and it will change how people keep their records, how they report to HMRC, and how they manage their tax affairs overall, because it won't be long before we, in my personal view, start moving to a lot more regular tax payments as well. It won't be that 31st of January tax payment date. It'll be more on a quarterly basis, very much more in line with PAYE and salary receipts. So that's where we're moving towards a much more modern tax system. And that's very much a statement from the government that it is still going to happen and it is coming in next year. to make sure you're ready.
So from outlining there, you are talking about that impacting a significant number of people.
Yeah.
Are there exemptions?
There are, yes. There's a couple of exemptions which already exist. If Making Touch Digital already exists for VAT, so that's already in place. And those exemptions are very much, if it's impractical for you to use technology, whether that's due to age, disability, or location, for example, or if it's not incongruous, if it's incongruous with your religious beliefs, so it doesn't tie with your religion. They're the two main exemptions that you can have with HMRC.
So just to conclude on what we've seen in the spring statement, how does that address things like inflation, public debt and economic growth? We've seen from what Graeme said earlier is that growth number is struggling to move. What are you seeing?
Yeah, well, I think it painted quite a bleak picture on all three of those fronts. So inflation is going to be above the target, the 2% target that the Bank of England set each year. So that's going to, they predict that's going to be around the 4% mark. What that will mean is for most savers, your cash is going to be eroding in real value because inflation is going to be running at a greater rate to interest rates, most likely this year. In terms of economic growth, I think, again, the forecasts have been halved for this year, and they look pretty bleak for the rest of the government term. One thing to be stated on that is the UK economy is very separate to the UK stock market. So the UK stock market is quite well protected in terms of it is a global stock market. So a lot of the companies that are on the UK FTSE 100, for example, are very global. They don't depend on what's announcements here and growth, particularly in the UK. So you will see a difference in the figures that the UK economy is growing at versus the rate that the UK stock market potentially will grow. That will be affected by other more global factors. In terms of bonds and gilts and government debt in particular, if inflation is going to be on the higher side, you would expect yields on government debt to be higher. And we have seen since the autumn statement that on a 10-year gilt yield, that has increased by 25 basis points current to date. So that's not great news, because the more that the governments are going to have to pay on servicing this debt means they're going to have to find this revenue. And Rachel Reeves is very, very keen on keeping her headroom in terms of her fiscal policies. I think they came close to breaking one of her fiscal rules this year and this spring statement. So actually they've had to this time make cuts on spending rather than increase taxes. If that pattern continues, it's that question on where they'll go in the autumn budget. Will they have to look at further tax rises? Will they have to cut spending further? So I think that's really unfortunately the outlook that's really come out of the spring statement for me.
It's a very difficult position they're in as a government, isn't
it?
They do have their own fiscal rules that are sort of restrictive against their own promises on the tax side, which don't really align when they've got gaps to fill. So something's going to have to break somewhere along the line, but not yet, I suppose, to take away from the spring statement.
Yeah, and I suppose to kind of bring our conversation together are there any sort of closing thoughts or messaging that you're seeing that our listeners really need to be aware of and perhaps taking action from today?
I think from my perspective, I think the fact that there was very little said from a tax perspective, at least in the spring statement, means that we have surety about what we're dealing with for the short term, which is always a good thing. I think if you can predict what's happening, things like the stock market tend to react well when they know what's going to happen. It's all factored in, they can price it in. Those changes, if they're expected changes, all come across very well by comparison. But I think the big thing from the autumn statement, autumn budget last year is look at those plans, whether that's inheritance tax you're looking at, whether it's your business profit and loss account. Make sure that you know what these changes are. These are significant changes. It might sound like 1.2% to national insurance, doesn't sound huge, but put that through your P&L account to see what difference it makes. Those figures are quite enormous, and nothing's changed in your business apart from your profit's gone down. So very much keep an eye on what that is, get that forecasting done, look at the plans going forward and sort of ignore what you knew and start again.
And do you have anything to add to that, Heather?
I would agree. It's really reviewing what the plan is now, and is that going to work with the rules and the tax legislation that we know is in place, and that's what's coming down the road. Definitely speak to your tax advisor, your financial advisor, and get a joined up plan to try and make sure everything aligns in the most tax efficient way.
I suppose that old adage of being prepared rings true where we are.
Yeah.
Thank you, Heather. Thank you, Graeme, for joining us today.
Thanks very much.